If you're within 10 years of retirement, there's a good chance that right now someone is making changes to your company pension fund that could jeopardize your future, just automatically in the background without you knowing. Today, we're going to teach you how to take back control of your retirement and your future. Welcome back to another episode of the Enough Club podcast. I'm Bryan Nicol.
I'm Pieter Villiers.
And today we're going to bust a myth. There's these rules of thumb that we have in finance. Sometimes the rules of thumb can be applicable. Sometimes they're not. When it comes to rules of thumb, I always ask myself, whose thumb is the rule based on? And so today we're going to discuss this belief that the older you get, the more conservative your investment portfolio must become. So just to start this conversation off quickly, I want to ask you, Pieter, before this call, you explained to me that rule of thumb about asset allocation. I want you to kind of unpack it because that's going to set the scene for the rest of the conversation.
Yes, Bryan. So what we typically find out when we start showing an interest in our finances is, we go read more books and we watch videos and podcasts. And oftentimes what we stumble upon are these rules of thumb. The rules of thumbs are great to get you started and to get you in the right direction and to kind of guide you towards a specific outcome that you're after. And one of those rules of thumb is based on the appropriate asset allocation. And what it basically boils down to is to say, we get our main asset classes like cash, bonds, property, and equity. And if we kind of make it very simplified, we can go with a combination of equity and bonds. And you'll typically hear online in financial educational media where they talk about a bond equity ratio. Should it be 100, 0, 80, 20, 40, 60? And what this rule of thumb refers to is in order to kind of understand how much equity you should have in your portfolio, and equity being the most beneficial asset class for long-term growth, the best inflation-beating type of asset class over the long term, you take 100, the number 100, and you deduct your age, the number, how old you are. And then what you are left with is how much of your portfolio should go towards equities. So as an example, if you are 20 years old, 100 minus 20 is 80, so 80% of your portfolio goes into equity. If you are 50 years old, it's a 50-50. If you are 65 years old, it's basically saying, okay, well, 100 minus 65 is 35%. So 35% of your portfolio should be in equity. And the idea behind this, the logic behind this rule of thumb is to say, if you are younger, you can have a higher percentage exposure to a growth asset like equity because you have a lot of time to wait out market volatility. But as you age with time, your capacity to take on risk reduces, and hence why you should start de-risking your portfolio, reducing the equity and upping up the bonds as you go on with life. So what this then sometimes boils down to is you get to the age of 60 or 65, and now if you just follow this very specific rule of thumb, you sit with a portfolio that has only between 35 and 40% of equities, the rest being bonds. So the question now comes, is this actually good? Is this a good strategy, or are you actually setting yourself up for failure in retirement?
Yeah. Now, thanks for that introduction. And I'm glad you spelled that out because I struggle to do math on the fly. I would have butchered the 100 less whatever the asset allocation was calculations. Now, the reason why we're talking about this today is because something we see with our clients often, many of our clients are about 50 or 55 or whatever the case may be, and they're employed at big companies, and these big companies have big pension or provident funds, right? And when you belong to a fund like that, you might have thousands of members of that fund through your employer. So these big pension funds, these umbrella funds, these provident funds, what they will do is they will offer default investment choices for your fund. So let's just, I know you use the word fund a lot there. So let me just explain this a bit. If you think of the money you've got that's growing for retirement, comes off your pay slip every month and it goes in, it's invested in something. So that's a fund. It's invested in something that's in the markets. But now not all funds are created equally. Some are more aggressive, in other words, greater exposure to equities, and some are less aggressive. Now, the more aggressive it is, the greater potential for returns over time, but then there will be volatility. So, with the market movements, the value of your fund will go up and down. That's not a bad thing. It's just a bad thing if, you need all of that money tomorrow to buy something. You don't want it to be going up and down the whole time with the markets. So what we find with these big companies is, most people out there, most employees are not so clued up on asset allocation, not clued up on investments. It's not their job. So the default selections that I mentioned earlier on are used often for many employees. Now, the default selections for many umbrella funds, retirement funds, pension funds, provident funds, whatever you wish to call it, they often use something called life staging. I don't know if anyone out there is listening to this now has heard of that term, a life stage model, a life staging, or a glide path to retirement. And now what happens is, the older you get, the closer you get to your retirement age as far as the company is concerned. So the company rules might be 65 is when, you have to retire by. It will then start managing your investment for you, your fund for you. And the closer you get to 65, it will start reducing your exposure to equities. And a good example of that is when you say 61, 62, it will allow you to have something like 40% equities only. That is a general, like a very vanilla kind of glide path or life stage to retirement. So the problem we have with that is that you didn't necessarily ask for that to be done. It's something that's done automatically. And many of the clients that we've worked with have come to us when we onboard them as a new family, and we work through all of their financials. We look at the statement and we say, oh my gosh, you're 60 or 58 or whatever, and you've got 50% exposure to equities instead of the 70, 75. Now, they say, okay, well, I don't know, I'm just in this default portfolio that we've got. But the problem is, an investment that's invested in, say, a fund that's invested with, say, between 40 and 60% equities, it's probably going to target inflation plus 3 every year. Whereas if it's 75% equities, it's going to target inflation plus 5 every year. That's what it will target. But the actual returns, when the market is running, like we've had over the last several years, you're going to lose out quite a few percent a year, which will then compound and compound into the future. Because you were by default put into a more conservative portfolio just because, you got a bit older. So Pieter, we have that now with clients. We see that with clients, and we obviously go about remedying that. Can you just, for everyone out there, they might think, I've always heard this wisdom, so to speak, of, you get older and therefore you must reduce the size of your portfolio. I know that people back in the day died at 65. They retired and they're just kind of almost like they were tickets, right? So, what are we finding with our clients now? Maybe just share a bit to the listeners out there, how long we plan for and why it's not necessarily ideal to follow some sort of a default glide path.
Yeah, people get older with medical advancements and just general, I guess, increased cost, increased quality of life. We get the average lifespan of individuals increasing. You're right, at some point in history it was maybe 65. We're now planning until 95, at least for us, for our clients. But then, if mom and dad or granny and grandpa has lived past 100, we might push it up to 100 or 105. There's a very good chance that might happen. And we want two things not to happen in retirement. We don't want to run out of money too soon. That's a problem. Equally, also don't necessarily want to not live the best life we can in retirement and die with a bunch of money and just pay taxes. We want to find a nice sweet spot, equilibrium of, living the best life we can until a certain age that we're comfortable planning to. And for us, it's typically that 95 to 100. So let's use that number. Let's use 95. If I retire at 65, I still have 30 years, 3 decades to invest. Now let's go 3 decades back, 35. If you ask a 35-year-old or you advise a 35-year-old that's investing for his retirement at 65, the good advice would be you need to invest aggressively. You need to have enough exposure to equity because your biggest risk over a long time period is not volatility, It's inflation. It is the eroding effect that the increased cost of living will have on your capital. So a 30-year time frame is a long time. And if you retire at 65 or 60 or 55, chances are you still have 30 years left. So going too conservatively into your portfolio so early on might not seem at face value like a problem, because our human minds don't think exponentially over time. But even a 1 or 2 or 3% difference in return, because of the asset allocation, because we had 40% equities and not 75%, over 30 years could mean a substantial difference in the actual reality of the retirement you get to live, the quality of retirement. Because if you go too conservatively, we're not able to grow our money to beat inflation by the margin we need it to beat. If we think about things like medical aid, increases by inflation plus 4%. So we need to be conscious of the timeline of what we're actually investing for in retirement. And it's strange how the laws in South Africa work, because with retirement funds, saving up to retirement, we are constrained by Regulation 28, which limits us to 75% equities, 45% offshore. If we convert the RA to a living annuity, there's no constraints. If it's with a external provider, then we can go 100% equities. So there's nothing keeping us from having good exposure. There is a important, balance of not withdrawing too aggressively if you invest very aggressively, but that's maybe a topic for another day. The point is, your asset allocation is always going to be the most important decisioning factor. And let's also play out the scenario of, let's say we have de-risked our portfolio from 60 to 65, and then let's say we realize this and now we're increasing our risk again. That might still mean that those 5 years we sat on the sidelines of the market to an extent, which also, there's also a lot of studies being done that if you only miss like 10 of the best days in the market over like 20 years, your effective portfolio return could halve. And that's also a risk of de-risking too quickly. And I think the reason why most people think about doing it is because they're scared. They're scared that if I'm going to stay in the 75% equity portfolio at retirement, when I need to convert to a living annuity, it's going to be a market crash. Now I'm drawing down and I'm eating into my capital. And, this word comes up, the sequence of return risk. So I think maybe let's address that, if you don't mind, Bryan. Take us through what that risk actually means, and why that is the risk that we need to think about, and not this, and how we can mitigate against that in a different way that's actually going to be much more beneficial long term, as opposed to de-risking our total portfolio over time.
Yeah, thanks. The sequence of returns risk refers to your investment returns that you get on a portfolio. It's not the same as how can I say, every year, say if you take January to December, your investment return might be, 12% the one year, 3% the next year, 25% the next year. It's not a straight line, but when you average it out over time, you will see it averages, maybe 10, 11, 12% a year. Now, we often think, okay, so I will get 10% a year or whatever. Well, it doesn't come in a straight line. It is up and down. And so the risk that a lot of retirees have is year one, they retire, and now there's zero growth in the markets. Maybe it's flat, 0%. Like, okay, so now my money is not, I'm going to withdraw, say, 4% or 5%. So now I have 95% of my capital. I don't have 100% anymore. Or you might on year one have a market crash. Or the year before retirement, you have a market crash. And now you think, oh my gosh, now what? I have to start drawing a pension and my money is less than it was last year. Those are valid concerns and there are ways to manage that. But what we tend to find is that these funds that people are often invested in, these default life stage type of portfolios, from the age of 55, they start de-risking. And I use inverted commas for de-risk. They start de-risking these investments. So they're trying to say, look, yeah, you're going to retire in 10 years' time. We should start hiding your money away from, the big bad stock market and put it into money market and bonds and that type of thing. So 10 years is a long time. It's a decade. It's a hell of a long time. And so to start doing that is crazy. Now, one of the reasons why these life stage strategies exist is because not only did people, I think not have a long retirement. 65, they retired, and maybe, a few years later, they weren't with us anymore. But on top of it, back in the day, people would buy pensions. They would buy a guaranteed annuity, and they would have a pension for life. So you work at a company for 30 years, you get a big pension, and you go and give it to your life insurance company of choice, and they give you an income for life. Now, you might be someone who enjoys the idea of having that income for life, and you never have to manage portfolios. You don't have to leave anything to, a legacy for kids or anything like that. And maybe that is good. And then if that's the situation for you, then maybe de-risking, so to speak, reducing equity allocation leading up to retirement is a good thing, because you're going to need as much as possible on day one of retirement to go and buy that pension. But guaranteed annuities, at least in South Africa, are outside of the norm, like for people to purchase them. Most people go to living annuities. There's a couple of reasons for that. Firstly, the living annuity, if you pass away next year or whatever, you can still leave that to your children. You can leave that to your spouse. You can leave a legacy. All that money is not gone. Secondly, the rate you get on income if you retire, say in your 60s, versus if you try and get a rate on your income if you're 70 or 80, will be very different. They'll give you a lower income, obviously, in your 60s, because you could live for 30, 40 years. And then when you're 75 or 80 and you use some of your retirement fund to purchase an annuity, you will get a higher guaranteed pension for life. So now you have levers to pull, but if you go straight from retirement and you buy a guaranteed annuity, that's the dead end. Like there's nothing beyond that. That money's gone forever. You will get an income for life, but that money, that capital is gone. But if you use a living annuity, you can still use a living annuity one day to buy a guaranteed annuity. Yeah. So people just often generally go to a living annuity first because you've still got options later in life. Now, if you're going to get a living annuity, then your money will remain invested. So you'll take your money from your pension fund at work. You're 60, 65, whatever, and you decide you don't want to work anymore. And you will maybe withdraw some cash, but you will put the rest almost like sideways into a living annuity. You'll use it to purchase this living annuity, which will then pay you an income. And what you might find is it will be invested very similarly, especially if you're going to withdraw anything above 3.5% or 4%. It's probably going to be invested in very similar funds than that a retirement fund would be invested in. 70, 75% equities, half local, half offshore, or whatever the case may be. So now, even if there's a market downturn, so to speak, at retirement, you will take it out of the one fund and put it into the other one, but it would still be roughly 60, 70% equities or so on. So you would still be able to participate in the recovery of the market. It's not like you're taking that money out of the pension fund and keeping it in a safe. You have to relieve that pension fund, but you can go into another balanced fund or whatever investment you're going to be in. So you will participate in the market going forward. And you have to, because if you're going to live for 30 years, your retirement might be just as long as your working career. So you've got to take that money and grow it. So now the way to mitigate against that, the way to make sure you don't fall victim to that, is to, leading up to retirement, you can start putting money aside from your discretionary capital, money in unit trusts or ETFs, whatever, and you can start keeping some of that aside. And then by the time you get to retirement, you have your first, say, 2 or so years worth of income kept aside completely. Generally, we kind of default to like 36 months worth of income. You keep the 36 months worth of income separately in a safe income bucket, so to speak. And the rest of the money, even if there was a market downturn or whatever the case may be, you can just let it participate in that and recover. And you've got more than enough breathing room to weather those storms. So I think the idea behind this whole default kind of portfolio where it goes according to your age and life stage and it changes the allocations, I honestly think it's outdated. I think it is based on something that people did in the 70s and 80s and 90s when there weren't other options for them. But now there's a whole lot of other options. It's much greater access to finance, to investments, to to, platforms that consumers can have. And so I think it's outdated. I think it hurts people. But what we tend to find is, our clients, all of whom are like highly skilled, qualified, educated, and senior in their positions of work, they just don't know. And so we get a 60-year-old or 55-year-old come to us, and the fund name is something cautious fund, or the something moderate fund, or the, something like that. And then we know, ooh, that sounds like you leaving some returns on the table. And I can give you an example. I've got next to me fund fact sheet from one umbrella fund company. I won't mention who, but the difference in returns per year on average over, say, 3 years between their aggressive accumulation type of life stage fund and then the conservative one that people are supposed to be in from like 60 years old. Over the last 3 years, it's about a 2-point-something% difference in returns between the two funds. Now, you might say, oh, it's 2%, it's nothing. But now you take that and you think of, say, a 20 million rand fund. Now, 2% of that every year, and now you remain invested similarly over time. This, because now you're old, you're supposed to now, you're 65. It's tickets, you're supposed to keep your money super safe. And so you go from a 40% equity fund to another 40% equity fund for retirement. And for every year, you're losing out roughly 2% a year on 20 million, 30 million, 15 million rand. Like you said earlier on, Pieter, I think, correct me if I'm wrong now, but you said it can potentially halve your profit at the end of the day on a fund over 30 years or something like that. And that's the opportunity cost we're seeing, which is incredibly painful for investors.
Yeah, it's I think the maths comes down to like a 1% difference could mean like 25% of the portfolio over like, I think 40 years. So 2% difference could almost get us to half. So I think that is, yeah, I agree. I think the logic behind those funds was with the assumption that most people will buy those guaranteed pension funds, which still exist today. But very few employers actually offer guaranteed pension funds anymore, because then the risk is mostly on the employer and not the individual. Whereas now most people are in what we call defined contribution funds, where you have to then go into, it's not you don't get a guaranteed pension for life from your employer. You kind of have to decide, I've got this pension pot and I can go buy one if I want to. But I think I agree, it's outdated, and it's probably a bit of an easy, lazy way to do for retirement planning for at scale, where people tend to go more cautious. If it's like let's follow a sequence that's going to be most appropriate for the most majority of people, and if you go too aggressive, then that's gonna potentially cause some upset. So that's probably why it exists, but that's why it's so important if you do have a company pension or provident fund, that you go and look at. Just, it's easy. You download your statement, you ask your HR, send me a member benefit statement of my pension fund, and then you just scroll down to the section that says what fund selection you are in, and then they can also provide you a fund fact sheet or a MDD, minimum disclosure document. You open that, you read through it. If it says kind of something in the region of, like I said, a life stage or gliding path, or this will reduce over time, it may not sound like a big thing, but it is a big thing. And you need to be aware of that. And you as an employee will, in most cases, have a choice as to what you want to invest in. And your employer most likely has a list of many funds to choose from. You just need to be cautious not to go too cautious with your investments close to retirement, because you still have a long-term retirement.
Yeah.
And if the fear is that, yeah, but if I'm too aggressively invested and I retire and there's a market crash and I'm going to lose, I'm going to eat into my capital, then following that strategy, like you said, that you take a portion of the discretionary money, the stuff that's not tied in a pension fund, and that provides an income for 2 to 3 years of in retirement, so that you have breathing space from your retirement fund not to have to eat into that capital if you don't want to. If you don't want to retire from it, you don't have to. And that is why looking holistically at your entire picture becomes important, because you can only really make decisions on that specific fund if you know what else is available to you. And also, leading up to retirement, if all of your capital just sits with one company, one pension fund, the value at surface level might look great and you might have enough to retire from, but you're going to miss on a lot of liquidity in your overall picture, which could influences the quality of retirement. And if you are 10 years away from retirement, you still have time to build up that liquidity portion of your investment. So that is why if you're in that space of 5 to 10 years from retirement, go check your member statement, check the fund you invested in, and make sure that you are now starting to make good informed decisions about your future. You still have time to make up for potential mistakes that could cause the quality of retirement to be less than what it could have been. I hope that will help.
When we discussed earlier on the asset allocation being reduced, towards equities closer to retirement, what we mean is what you can see here. Generally speaking, a retirement fund is invested 70-75% in equities, and it's regulated by something called Regulation 28. You can't invest more than 75% in equities. Now, you want as much growth as possible, and so this would target inflation plus roughly 4 to 5% a year. So you will see on the graphic that you've got 70% equities, and that is from 7+ years out from retirement. So if your company's retirement age is 65, it's going to be 7+ years back from then that you will still be potentially invested in a fund that is more appropriate for a long-term investment, 70% equities. Then what happens is this glide path, this life staging strategy, what happens is they start reducing equity allocation the closer you get to retirement. So roughly 5 to 7 years away from retirement, they will bring it down to 60% equities. And then 3 to 5 years from retirement, 50% equities. And then 3 or so years away from retirement, it's going to bring you down all the way to about 40% equities maximum. And 40% equities is a maximum, it's a ceiling on that bracket. It's not necessarily going to be invested at 40% equities because the fund managers of this particular fund, which you're invested in, will say we can go up to 40%. But if we believe there's going to be, choppy water ahead, we're going to reduce the equity exposure even further. So all of those amounts that you can see in the left column are ceilings. They're not exactly what the asset allocation will remain at. Now, as Pieter, you mentioned earlier on, every time you go down that 10% in equities, it might impact your future considerably, X amount of returns per annum that you can forfeit. And so if you're going to, for example, retire at 65, but hopefully live to 95 or 100, that's another 30 odd years of investment term. You can kind of view retirement as not the finish line, but kind of the halfway line when it comes to your retirement career, your investing career rather. So instead of thinking, oh, this is it now, I'm done, well, you're kind of halfway as far as an investor is concerned. Plus, if you want to leave money for people, children, spouse, or whatever the case may be, you need that money to actually live and grow for more than the 30 odd years. And so, as you said, Pieter, but I want to mention it again in case anyone forgot. The way to find this out is to look at their member benefit statement and just to understand what fund you're invested in. And Pieter, maybe you can just elaborate just 2 or 3 words quickly. What words are used in naming regimes of funds that might set off alarm bells if you're in your 50s and you see this word on that member benefit statement describing the fund you're invested in?
Typically, if we look at let's say 40% equities, you'll see something like low equity or cautious. They will describe it that way. If we think about, let's say, 50 to 60% equities, you'll see medium equity or moderate. And then probably on the worst side, if it's like no equities, it could be something like an income fund or a money market, which is just way too conservative. So what you'll typically want to look at is, let's say, about equity 70, 75%. That would be considered like a high equity or a high equity balanced fund. That's typically what we want to see. And if you look at the fund fact sheet, go look at the asset allocation. Sometimes they will split local and offshore equity. So you kind of count the two together. And if it gets you in the region of, I'd say at least like 65 to 75, then okay, that sounds good. But if it's below that, unless there's a very good reason, and I don't know, the fund manager for some reason believe at that point in time it's better to go conservative, but the mandate still says high equity, then that's different. But I think those are, if I see something like cautious, low equity, income fund, money market, yeah, that's probably a sign that we way too conservative, or even moderate and medium equity. I think might be bringing a lot of questions to surface.
Yeah. No, thanks. I think it's a good way to end off. And just to remind people that these strategies, this whole rule of thumb, these strategies they do in pension funds where they reduce your exposure to equities closer to retirement, they believe it's managing risk. The real risk is running out of money. And so if you spend 10 years on the sidelines and not investing, you're going to potentially jeopardize your future, jeopardize your retirement. And instead of having peace of mind in retirement, you waste years that lie ahead of you. You're now going to be stressed about money. So don't do that. It's a simple fix. Look at your member benefit statement. Look at the fund you're invested in. Interrogate it. And if you need to make a change, go to your HR or payroll people and make the changes that you need to. The timeline horizon for investing is not just from when you say 25 until 65. It's 25 to 95, 25 to 105 for all we know. So retirement is definitely not the finish line. It's potentially the halfway line. And you've got to treat the investments as such as well. But that's all from today. Please, if you did enjoy this podcast, you can like the video, leave a comment for us, subscribe to the channel. And also just send any suggestions in the comments for future topics as well. And look out for those. We try and release a new episode every 2 weeks. But that's all from me at Freedom Financial Planning and the Enough Club podcast. I'm Bryan, and all the best. See you later.